Welcome back. All public issue of shares is categorized as either IPO or FPO. IPO stands for Initial Public Offering. FPO stands for Follow-on Public Offering. Let's discuss this further. Public issue of shares is categorized as Initial Public Offering or Follow-on Public Offering. Initial Public Offering or IPO is the first public offer made by the company. Post-IPO, the shares of the company become widely available for investment by the public. Through the IPO, there is a change in the shareholding pattern of the company. After the IPO, instead of just the promoters, now all kind of investors also become the shareholders. IPO involves either fresh issue of shares by the company or offer for sale by existing promoters or institutional investors. In case of fresh issue of shares, the company issues new shares so that they can be sold to the public. On selling the new shares, the capital of the company increases and the percentage shareholding of existing shareholders comes down. In case of an offer for sale, the existing shareholders of a company offer a part of their holding to other investors. The share capital of the company does not change as the company doesn't issue new shares. This is because the proceeds of these sales go to the existing shareholders who are offering their stake for sale. Hence, the proceeds do not go to the company and there is no change in the capital of the company. As a result of sale of shares, the percentage shareholding of existing shareholders who have offered some of their shares for sale comes down. Now let's look at FPO or the follow-on public offer. The FPO route is taken by an issuer who has already made an IPO in the past, that is by companies who are already listed on the stock market. When such companies want to make a further issue of securities to the public, they can do so by offering a follow-on public offer. The company may take an FPO route if it requires additional capital for growth or in order to restructure its capital by retiring debt. Some FPOs may also happen through offer for sale, where existing shareholders offer some of their shares for sale. This may happen if the promoters would like to dilute their holdings in the company after the lock-in period imposed at the time of their IPO is over. Once the shares are made public through an IPO, these shares become available to be traded on the exchange, which is essentially the secondary market. In the next video, we are going to discuss secondary market in greater detail.